Let's talk in this session about what I consider to be possibly the two most important responsibilities of someone who will be managing a portfolio actively. In other words, the responsibilities of an active investor. In the previous session, I focused on portfolio management. I explained, just to summarize, that there were two paths that you could choose to walk down. You could choose to be an active investor, or you could choose to be a passive investor. If you choose the path that leads down the active route, it's important to understand that you have to become a portfolio manager if you're going to do it yourself. But before you start managing a portfolio, I explained that there were some simple processes that had to take place before you started managing a portfolio. I said, in order to manage, you should have a portfolio. And that means that you should have selected or you should have constructed a portfolio. But before you construct a portfolio, you must select the assets. And before you select assets, you must have an understanding of your objectives. So in principle, if you were to follow the chronology, it would be define your objectives, establish your strategy, select the assets, construct a portfolio, and manage the portfolio. If you chose to go down the path of a passive investor, the responsibilities are much less. All you have to do is simply choose what index or indices will be in your portfolio. There's very little needed from you or needed to be done by you. You just simply have to review your portfolio regularly. In today's session, I'd like to move and continue down the path of the active investor, and I'll talk about what I believe are the two fundamental responsibilities of an active investor. We start with the first. I'm going to summarize the first responsibility under the word asset selection, or the two words asset selection. When I say asset selection, I'm referring to the chain of events or the chain of responsibilities. That includes objective definition, that includes strategy implementation, that includes asset selection, that includes constructing a portfolio, and then managing a portfolio. I'm going to group all of those under the umbrella called asset selection. That's the first. Once you've selected an asset, or once you have a portfolio, or once you're managing a portfolio, the second most important responsibility on your part is knowing how to adjust your portfolio based on the cycle of the market. In order to understand that second responsibility, let me explain something. There is no such thing as a traditional marketplace. When we talk about markets in relation to investing, we're really talking about people. Traditionally, if you go back to, say, the early 1800s, there's something called the Bretton Woods Agreement, or you go to what used to be the London Stock Exchange. You had men, predominantly back then, who congregated in a particular location, and they traded, they exchanged, or the battered ideas and battered prices and battered investments. That developed into what was then a more, what you might call classy way of exchanging ideas or trading shares or buying and selling companies. And that became something that was done within a building, and you had so many people, traders, they are called, or market makers. In today's times, we've in many ways done away with the traditional physical approach, and we now use computers, and we have what we call an exchange or a marketplace, and it's usually virtual, and that simply means you can go online and you can buy and sell. So when we use the word market, we're referring to people. We're referring to the people who buy and sell companies, or buy and sell shares, or buy and sell assets, bonds, real estate. Because of the involvement of people, you're destined to have emotions, and therefore the psychology of those individuals. When you congregate those psychologies or individual emotions, you come up with a pattern. It's a graph, it's a chart. In some cases, when the mood in the market is optimistic, there's a certain behavior. Sometimes the mood in the market is pessimistic. There is a reversal of behavior. So understanding the market, but more importantly, being able to read where in the cycle we are in the market is very important. Whenever you have a country that uses credit and does not rely only on the productivity of the citizens, in other words, you can borrow from your future self, you will always have cycles. Cycles are caused simply because when you combine your productivity with your borrowing from the future, it means you have a boom today because you borrowed from your future self. But the money you borrow, you have to pay it back. And that simply means that sometime in the future, you would have to spend less than you earn because today or sometime in the past, you had borrowed and you spent more than you were earning. For that reason, you have an up cycle, which is when you borrow, and then a down cycle, which is when you have to repay. That is typically what we call a cycle. Cycles come in various ways. You have short cycles, you have long cycles. Short cycles might last 5 years, long cycles might last much longer. It could go as long as 15 years or even greater. Those cycles simply evolve over time. Now, if you go further down and you go into a country, you might have the country's cycle, growth cycle, productivity cycle, interest rate cycle. So there is always a cycle. In this case, I'm referring to market cycles. I'm referring to psychology. Sometimes the market is what we call bullish, meaning euphoric. Sometimes the market is bearish, despondent. The emotion of the market really depends on the psychology of the people within. So, for example, in today's times, we have a public health epidemic caused by the coronavirus. What that means is that there is some level of pessimism, people expecting the worst to happen. And therefore, if you studied, in this case, equities markets or stock markets, you find very easily that there is no much optimism in the market. People are expecting the worst. For that reason, the prices of assets or companies reflect that expectation. And therefore, you can read what the mood is like in the market. Now, if you go backwards, just rewind to 3 months ago, go back to January, or even better still, go back to December 2019. The mood in the market was optimistic. Stocks were going up in value, or in prices, I should say, and people were buying. People felt, this is great. This will not stop. So what you do is, if you were to plot 2019 on a graph with 2020, what you find is 2019 was somewhere here, and now 2020, because the cycle has gone down. Now, this cycle might keep going down, it might stay flat, or it might go up. No one can say. However, the investor's job, or your job as an investor, is if you have a portfolio, you've selected the assets, one of the things you must decide is, are you intelligent enough? Are you confident enough to recognize and infer from the attitudes and the behaviors and the psychology of the market what the market will do? Now, let me clarify so you understand that I'm not talking about market timing. What I'm referring to is being able to read the emotions, the psychology of the market in the present, not anticipating the future. Market timing refers to trying to predict what the market will do tomorrow, next week, next month, next year. You're trying to make an estimation. In other words, you're trying to forecast the future. There are very few people who get that right. As a matter of fact, there is a saying that there are two types of forecasters: those who know they don't know, and those who do not know that they do not know. You want to try and avoid being in the second camp. Forecasters often get it wrong. In the short term, you might extrapolate and get it right. But if you look through the Forbes 400 list, there are very few speculators or forecasters who have got wealthy from their forecasts. As a matter of fact, if you studied the performance of every forecaster over a 30 or 40 year period, you find out very, very quickly that their success rate is abysmal, terrible. And that's just because there's a lot of randomness in the market. There's a lot of luck. There's a lot of people, emotions go up and they go down. And so it's quite difficult to predict. In 2019, December, if you asked anyone whether the world would have an epidemic of this magnitude by April or by March 2020, most people would have said, not possible, because no one could see it. And so if you were trying to forecast 2020, the first quarter, you got it wrong, even if you were forecasting in January 2020. And that's just simply because we've experienced something called the black swan. It wasn't predictable, and that is the nature of markets. So as an investor, one of the things you should recognize is you have a portfolio. You are responsible for managing it. There are two things you can do. You can buy, select your portfolios, choose the right companies, and hold. In other words, you ride the cycles with the hope that because you have selected the right assets, that the intrinsic value of those assets over time will keep going up, it will increase. And irrespective of the cycle or where and what happens in the cycle, you're holding on to the principle and the historical evidence that says over time, the market trajectory is upwards. So you buy here, you hold. And even if the market keeps going up, it gets to this point. That's the philosophy. On the other hand, if you've studied history and financial history, one of the things you recognize is that cycles have start periods and end periods. You might find if you go back, there was the 1987 financial crisis. There was this 2001, 2000 internet stock crisis. There was a 2008 financial crisis. So you always have occasions where the market becomes too excited, too optimistic, and at some point in time it has to self-correct itself. Between 2008 and December 2019, we had experienced the longest, what we call the longest up market cycle, the longest bull market in history, the longest. And for that reason, many people were, I guess, expecting that at some point the correction would happen, but no one could say when. You as an investor could decide, I do not know, therefore I will simply buy, hold my assets and wait. And over time I'll let the wisdom and the beauty of compounding increase my investment portfolio. And it net worth. You might also be the kind of person who is a little bit more sensitive and good at inferring on the mood and the attitude of the participants in the market. Which would mean, if you're really that good, you might construct a portfolio, and as you manage the portfolio, you listen carefully to the attitude of the market. And therefore, you can position your assets accordingly. And let me explain how that works. I'm not referring to buying and selling. That is trading or speculating. That's not what I'm referring to. I'm simply saying that there are times when, if you are the top of the market, the height of what you might consider to be an optimistic market, like in 2019 December, you may have made a decision that you would move from being aggressive and you move towards being defensive with your portfolio. In one of the earlier sessions, I talked about risk aversion, that there is a time to put on risk and there is a time to take off risk. And that's what I'm referring to here. A time comes when you have to say, this is not the time for aggression, because the risks, should the risks and the fear occur, I lose much more than I gain. It's a matter of looking at the asymmetry of risks. When it's too optimistic, you could lose more than you could gain. And for that reason, you might decide my portfolio will be reconstructed. So I move some of my assets into either companies that are more stable, financially strong, large, can withstand a downturn. You might also decide I'm going to move my assets from the aggressive portfolios to something more conservative, maybe from high risk stocks to treasury bonds or government bonds, something safe. You might, in doing that, reduce your return, but what happens by that decision is you preserve capital. That's taking a position where you say, I will be a little bit more conservative, less aggressive, because we are at the height of the cycle. There's too much optimism. In the reverse, when there is a lot of pessimism, when there is despondency, when euphoria has gone, when people are scared, in other words, if you use the reference, when there is blood on the streets, you might decide this is a time for aggression. So portfolio management could involve moving your assets when it's quite low in the cycle, when there's pessimism. You might move yourself into more, I wouldn't say risky, but I would say more calculated risk type opportunities. Meaning, everyone is running away from taking risk. Everyone is fearful. Therefore, there's no optimism. Therefore, people are not willing to invest. There isn't enough capital. That might be when you decide this is the time to go all in. The key thing to remember is this. Cycles occur as a result of people and emotions, psychology. There are other issues or items that affect a market cycle, macro factors like interest rates, currencies, geopolitics. In this case, for today, public health, epidemics, they vary. So let me see if I can bring this to a good conclusion. I'm saying this, as an active manager, there are two responsibilities you have. Asset selection, or managing your portfolio. And that simply means choosing the right assets, choosing assets that will do well at the right time, and staying away from assets that may not do well at the wrong time. In other words, it's a case of just choosing good assets. Or what we call cycle positioning, meaning that you choose to select or adjust, that's the right word, adjust your portfolio to suit where you might be in the cycle. If you decide I cannot read the cycle or I cannot infer from the cycle, then you do what's called buy and hold. You buy and you just hold, with the whole idea that as the market cycle fluctuates over time, the value of your assets will keep going up. That is the principle behind passive investing. You simply buy and you just hold. You don't buy and sell, you just simply buy. On the other hand, there are some portfolio managers or investors who are very good. They're very attentive to the market and they can tell when it's right, when it's time to move from being aggressive to being defensive. So let me give you a good example. Most people think about buying and holding cash. That's not very smart because cash, in many ways, is a bad investment. Remember I explained the different denominations of assets. I said one asset is the type that is denominated in a currency, such as cash. It does not generate any return, but it's useful during liquidity crisis because then you can take advantage of opportunities because you have cash. But most people will use the word that cash is trash because over time, if you look at the return from cash, it's almost next to nothing. Today, you might even have to pay the bank for your money to be kept in the bank because we have what's called negative interest rates. In some locations, depending on how much you have deposited in the bank. So the point is this. It's not always a smart strategy to sell your asset and move to cash. Because if you do that, then you must make sure that you're completely correct. If you had done that in January 2020, just before the coronavirus, you would have been very, 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 very timely and smart. But that's very difficult. That would have been a case of luck as opposed to skill. Or that could have been a case of anticipating what could happen as soon as you found out about the virus. But most people over the last 10 years decided that the optimism in the market was too much. And there have been investors who've been sitting by the sidelines holding cash for the past 6-7 years. And that means they've made no return on their investment during the same time period when a lot of wealth has been created. So you have to be careful. But it comes down to you as the investor. There's nothing wrong or right. So you can do asset selection and portfolio management and you simply just leave it there. Or you can do asset selection and then cycle positioning, moving your assets based on what you believe the market mood and the market momentum might be. And let me qualify something and that would end today's session. I said before that I'm not referring to market timing. And when I say cycle positioning, you might be thinking, does he mean market timing? No, I'm simply saying you study the market, you recognize the signals, you ask yourself where we are today in the market, and you make your decisions based on today, not based on what could be tomorrow. The second you move from where we are to where we could be, that is market timing. When you make a decision based on today, that is cycle positioning. Very important. Now, I'll say something else. If you follow the approach of cycle positioning, because market cycles or economic cycles or bull and bear cycles do not occur every year. Sometimes they occur once every 7 to 10 years. It simply means that the opportunity to rebalance or to reposition, I should say, might come once every 10 years. Since 2008, we haven't had a correction. And this is the first time that has occurred. So in 11, 12 years, we've had one opportunity. If you go back to between 2000 and 2001, we had a correction. The next correction we had was in 2008. Again, roughly 8 years. So cycle positioning is not something that is done every single day or every single month or every single year. It occurs once every few years. And that simply means that the cost for having to transact by buying and selling or moving your assets around or, rebalancing your assets is reduced. However, investors who can do asset selection and combine it with cycle positioning usually do much better than those who just buy and hold. I'll ask you to do something for me. If you go on the internet and if you just search for stock market historic graphs, you can look at the stock market in the United States, the S&P 500, and look back all the way back to the 1913 period. Between 1913 and 2020, what you might find is that we've had so many corrections up and down, up and down, up and down. And if you study each of those areas, what you might find is, in some cases, if you bought and you held, yes, over time, you do well. Over a 50-year period, yes, you do well. However, whenever there is a correction, it takes a long time to come back to where you were before the correction. I'll give you a few examples and then we're done. Let me make it practical. I explained that the definition of investing was extremely important. I explained that an investment operation was one upon which, following thorough analysis, promises safety of your principal and an adequate return. And that the most important part of that definition was safety of your principal. You have to preserve your principal. Yes, you have to do thorough analysis, detailed analysis, quantitative and qualitative analysis. But if you did all of that and you lost your original seed capital, you failed. If you preserve your capital, you may get a low return, but it means you're still in the game. The worst part of investing is losing your cards, losing the game. A farmer has seed corn. A farmer doesn't eat his seed corn. He puts the seed in the soil with the hope that he will have a harvest. If you take the seed corn away from the farmer, he has no crop. Likewise, key thing to remember is this: preserving capital is king. I'll give you examples. If you lose 50% of your portfolio, let's say you buy an asset, a company, stocks, and it goes down 50%. In order for you to come back to where you were before the market went down, you would have to make 100%. Now let's quantitatively put this in perspective. On average, I explained that in the United States, the index, the S&P 500 index, over a long period of time has averaged approximately 10%. Approximately, usually between 7 and 10. In the UK, depending on the index you choose, is between 6 and 14. The FTSE 250, roughly about between 10 and 14. The FTSE All Shares, or the FTSE 100, between 6 and 8%. But we can extrapolate and say, on average, we're looking at between 7 and 10%. If your portfolio goes down by 50%, in order for you to come back to where you were, just to break even, it will take you 100% to come back. However, if it takes you 10% every year, in order for you to come back to 100, if you do it arithmetically, you're not doing it by geometric compounding, you're doing just simply basic arithmetic. Simply say 100 divided by 10, it'll take you 10 years. If you do it by geometric compounding, taking into account the reinvestment, it will take you about 7 to 9 years. What that simply means is that a 50% loss of value, in order for you to break even, if you had invested in the index, it will take you 10 years to break even. I'll give you another number so you can see how serious this is. If your portfolio goes down by 75%, you would have to make 300% to break back to where you were. That's the power of compounding. Compounding occurs in the upside and on the downside. You would have to make 300% back to break back to where you were should the market go down by 75%. Now, this is why protecting your capital is so important. Now, if we go back to the same analogy, and we say you can make 10% every year. In order for you to achieve your 300% goal, 300 divided by 10 is 30 years. But geometrically, you could simply say that will take you about 22 years. 22 years, because your portfolio went down 75%. And that's the reason why you have to be very careful about losing your capital. Now, I'll give you a shortcut or an example of how to understand these numbers. There's something called the rule of 72, or the rule of 70. The question is, how long will it take for you to double your money? You take 70 or 72 and you divide it by the interest rate, and that tells you how many years it would take to double your money. Really simple, and it works. So, if you think about this, we talked about 300%, to go from 10 to 200, to go from 0 to 100, which is effectively double, and double again to 200, and double again to 300, you're looking at 3x. If you take 70 and divide it by 7, using 7% as the interest, it's 10 years. So 10 years, 10 years, 10 years, 30 years, just to get back to 300%, which will break even to where you were before your portfolio went down 70%. Protection of your capital is the most important job you have. Now, here's the point I'm trying to make. If you're timing the market, because you can only do that once every few years, it's important to look at financial history, because what you recognize is, although buying and holding is very good, there are times when it's important to cycle position. It occurs once every few years. And the reason is because you do not have the time to simply sit back and allow your portfolio to rebound. The pendulum swings, but it doesn't swing in the same momentum. So you can lose 75%, like I said, but for you to get back to where you were, you need 300%. It's a big swing. You do not have time. So it's important to learn about markets. I'll conclude by giving you how to infer on the attitude of the market. Number one, psychology. Is there too much optimism? Is there too much greed? Is there very little risk aversion? Are people willing to pay any price? Are people saying, yeah, just buy the stock, or just buy it, it doesn't matter, it will go up in value? Are people a little bit more